Thank you, ladies and gentlemen. It's time for this market session. The theme is the Great 2025 Market Hunt, Timing, Trends, and Alpha Plays. And of course, we got who's who of financial markets here, and they're going to help us decode this current bearish phase that we are part of. Is this just a cyclical bear market? Is this a crunching bear market which is going to last a bit long? Is it giving opportunities? Or is it giving signals that you made your money over the last 3 years, it's time to pay back a bit to the market? Of course, on my right, I have Lakshmi, Iyer, CEO, Investment and Strategy, Kotak Alternate Asset Managers. To her right, of course, Vikas Khemani is there. Vikas is someone who has made great strides and now, of course, runs a very successful fund of his own. To my left, of course, we have a lot of gentlemen. Amit Jeswani, founder and CIO of Stallion Asset. Amit, thank you so much for being here. Vikas Sharma is here, Head of Wealth Management and Private Banking at IDFC. And of course, on the extreme left, we have Rajeev Thakkar, the CIO and Director of the Parakh Mutual Fund, which is one of the most successful mutual funds in India of late. So let us start. And considering that we are at the cusp of International Women's Day, let me start with you, Lakshmi. First of all, a very happy Women's Day. And I'm told that you link markets and Bollywood. So right now, given the kind of market we are in, what picture comes to your mind?
Oh, that's like a straight googly off. But halchal is the right word in the market, which is increasing your and my dil ki dhadkan. And so much so that we have to keep telling ourselves that कुछ कुछ होता है तुम नहीं समझोगे.
कुछ कुछ होता है मार्केट में बहुत कुछ हो रहा है लेकिन विकास lot of people are asking that is this time to just sell lock stock and barrel or is this a market in which you just really have to hold on for some more time and good times will come?
No, surely not to sell. I think nothing has changed from long-term India structural story. It continues to remain intact, and I think these kind of corrections are very much par for the course and happens every 2-3 years. I mean, we have a short memory, of course. We very often we keep forgetting, but very similar kind of correction had happened in Jan to June 22 when the Ukraine war was around. We had a roaring bull market mid 20 and 21, and then everybody kind of came in and said it's going to last forever, and then we had Ukraine war and market corrected from 18,500 Nifty to 15,500, right? And that time, by the way, narrative was very similar. Global concern, inflation, earnings slowdown, and this is going to go away. And then we saw second half of this 22 started recovering on legs of skepticism, most amount of skepticism, and then we had a roaring 23 and first half of 24. So the point I'm trying to tell you, to me, it is kind of reminds me of the similar time period where Nifty has corrected from 26,500 to 22,000, which is almost again 18-20% correction. And again, same geopolitical, worries, earnings slowdown worries and all. So I think by and large, I feel that most of the damage is done. There's no point, if you didn't sell last year, no point in selling now, lock, stock and barrel. Rather, I would say that, valuations have corrected. It's a time, these kind of corrections are par for course in long structural bull market. So long-term investors have to remain invested, and if you have money, invest. If you don't have money, stay put.
Okay. Rajeev, coming to you now, because this time what's been different is that the valuations when the correction started were way out of whack, especially for mid-caps and small caps. And since your founder's philosophy is something that, of course, you very ardently follow, is this a market in which you have taken a lot of cash call? Is this a market in which now you're deploying cash? How are you approaching it? Your fund size is pretty large now, so you have fair bit of idea of how the market is acting right now.
Sure. So, Anuj, the market is what it is. I don't think there's anything exceptional that has happened. It's just that so many new investors have come to the market and they have to learn some old lessons. There's nothing wrong with the market per se. Today, a 1-year bank CD is giving you 7.5%. A lot of people spoke about long-term equity returns, 12%. So if you are not buying equity and if you are putting money in a bank CD, you are, let's say, losing around 4.5%. Now, given the kind of volatility that is there up and down, there are plenty of opportunities to deploy that cash that is there. I don't think we are in a hurry. there's no need to force yourself to buy if you're not convinced either on management quality or on balance sheet quality or on valuations, business model, etc. Today the market is, I think, I'm finding pockets which are looking very interesting to deploy money, as well as there are pockets which are still looking very frothy. So I don't have an index view or a overall view, but we will be able to find opportunities surely, given the kind of fall that has been there.
Oh, absolutely. Amit, that's a very interesting point, right? Because, like it or not, a large part of new money, which sort of got in after COVID, has not seen a bear market. I think all of us are old enough to remember the 2003 to 2008 phase where 20% was par for the course. 10% was par for the course. We had 2 or 3 instances of 20%, where the global financial crisis, when the market, even at index level, fell 58%. It felt bad, but we all knew that, it's going to bounce back. But the new money has not seen it. And all of a sudden, they used to think the market's like an ATM machine. Just go there, put your card, take the money out by evening. That has changed. How do they negotiate with this new reality?
See, a lot of people will learn in this bull market, and I hope we are ahead of the curve. But the stocks that most people own will not come back. There'll be new leaders, brand new companies which are not so large right now, not owned by anyone. They will be in neglected zones. There will be some kind of change that'll happen. There'll be new leaders to the bull market. The bull markets keep changing every cycle. From COVID as well. If you think, since you talk about COVID, it's been about 5 years to COVID right now. When COVID happened, the stocks that were leading were technology stocks, pharma stocks, chemical stocks. No one was looking at government stocks that time, and they topped in October 21. 9 months there was a bear market after that, and then you had a brand new kind of stocks, government stocks, Adani Group, that came from nowhere and created the largest ever market cap. And if that point of time you owned technology and chemical stocks, you would be a sucker, basically. You would have lost a lot of money. Even if the markets went higher, there'll be a new kind of stocks that will go higher. They will have patterns of high growth. Typically, trends get created by some kind of disruption. COVID created China to stop exporting, and that's how chemical prices went through the roof. That's how, like in 2022 war created a tailwind for defense stocks, and government started spending very aggressively in India. I think the next tailwind, we need to see where's the next change. I believe the next change will come in April when the tariffs, all your tariffs go online. Clarity will come. The biggest change that I see today is Trump. And that policies of Trump can have an impact, like 20% tariff on China and 0% right now on India. You already start thinking that which are the kind of companies which start benefiting. Of course, that can change on the 2nd of, and that will change on the 2nd of April.
Surprisingly, China is doing better than India. The Chinese market is on a tear right now.
Because the kind of stocks that are moving higher in China are not export-driven stories. They are local Chinese technology companies. So the quality of, like basically it's basically your Alibaba's, Tencent, etc., which are moving higher. It's not your exporters. That is not where the trend is. The trend is towards local Chinese consumption, and basically that's what I think. But I think there'll be new leaders. Hopefully we'll be able to catch them, and that is where the large alpha would lie.
Oh, absolutely. That's the key point, right? Catching the next leader. Now, because since you head the wealth management business, a lot of money in the market has come from family offices. A lot of money has come from corporate treasuries. A lot of money has come from CEOs, some of them perhaps sitting here and investing in the market. What is your sense? Is this money still here? Is this going to be sticky money, or is this going to be, saying, oh, maybe this is not for us. Let's just take our money somewhere else.
No, so the segments that you mentioned, Anuj, I feel that clearly is sticky long-term money. And I'll tell you the reason also, what you started off asking Lakshmi and Vikas, that is it a time to start selling lock, stock, barrel and move out? This is typically an investor psyche problem. There's a Morgan Housel session after this where he's talking about psychology of money, and I'm sure he's going to talk about this. Because when the markets are in a phase like this, which is a bear phase, people start thinking on, whether this is the right time to exit, should I sit on cash? And when the markets are in the very euphoric stage, everybody's talking about, adding more money and entering the market. What we need to realize is that valuation is not the only factor that determines, if it's a right investment to make. There are so many other investments. For example, valuation in Indian markets have never been cheap. Very, very few cycles you've seen where valuation has come cheap. There are a whole lot of other factors like liquidity, for example. Post-COVID, there was so much of liquidity, nobody really cared about valuations, right? Similarly, there are various other factors which need to be taken into account when, when you're putting your money out. And India is never going to be really a cheap market. The current, correction, which is largely led by lack of liquidity. There's a liquidity deficit. Earnings have been muted. Earnings have been, dramatically lower than what it looked like it would be a year back. So it's a good correction. It's a good time for the market to resort back to reasonable valuations. And, I'll conclude with a quote by, one of the very famous authors, stating that anything that is fundamentally great but having a temporary problem to be fixed is a great investment to make, And that to me defines India at this point in time, fundamentally great, but facing, headwinds at this point in time which seem very temporary. So great investment opportunity, anything, that defines that kind of.
The problem is this temporary phase is now entered 7th month, and it's almost created a bit of a record that we have never had this kind of correction. Because India has always been expensive. I take this point, but India has been expensive because it gives you the kind of returns that it used to give in earnings, and the market essentially in the long term has just tracked earnings. If you see the Nifty's CAGR, it's matched the Nifty's EPS growth, but we've had record quarter after quarter earnings downgrade, and it doesn't look like it's going to end anytime soon. So what makes you confident that, okay, maybe, we are very close to some kind of bottom?
Very good question, Anuj. I think if you see, what was the reason for slowing down of earning, in last 2 quarters? If you study, see last year,
elections? Elections?
No, not elections. I think if you see last year, RBI took maybe it fell in love with rupee and it defended rupee, and in the process ended up creating huge amount of liquidity deficit in the system, right? Secondly, and rightfully, they came down heavily on unsecured loan and microfinance loans, so NBFCs were curtailed. So basically, there was a lot of liquidity related issues driven by the RBI policies last year. That got coupled with, your government elections, which obviously slowed down spending, as well as the payments released on the government contracts, right? So, both of these issues created a huge amount of liquidity stress in the system. That impacted corporate earnings with a 2 quarters lag. Now, if you see, 2 policy pivots have happened. RBI has, visibly worked on liquidity surplus. They have cut interest rates. They have reduced risk weightage to microfinance, NBFC lending, and of course have been a lot more accommodative in their stance. So that tells you that RBI has clearly moved towards growth. Secondly, government came, and I think as much as it appears that, the big tax rebate which government gave up to 12 lakhs of rupees, it is a very, very significant move. It's not only about consumption. Think about it today, 8% post-tax return for a very large population of society, middle class, lower middle class, where, you don't pay much tax on that. So effectively bank deposits become very, very attractive. So that will drive money flow back to the banks, which was constrained earlier in last, 2-3 years. We've been kind of complaining about it. Yeah. So all these big policy, and government has of course come out aggressively spending money and releasing payments and all those things. So what basically created a liquidity strike in the system is pivoting. Now I do believe that like it had negative impact with a 2 quarters lag, it will also have impact on the corporate earnings with 2 quarters lag. So maybe Q1, Q2 of next year, it will start impacting. I have no doubt because I don't think fundamentally anything is changing, except the fact only thing which you can worry about, it will be the policy of Trump and the impact of in India. But I don't think they are materially changing India's manufacturing stance or anything else. We will have to see, but I don't think so far, at least whatever little understanding I have, the corporate earnings, I do believe, will start picking up, in a quarter or two, because this macro tends to have impact with the lag. That's my perspective.
Oh, absolutely, Vikas. And, I think all of us would have seen those memes, right? Papa कहते हैं बेटा इससे अच्छा तो मेरी FD में ही रहने देता पैसा. And mummy is saying कि gold ने इससे अच्छा return दे दिया, तू बेकार में equity में डाल के मेरा पूरा पैसा तूने खराब कर दिया.
These memes will change sometime. अरे पहले equity में डाल देते तो बेटा ठीक हो जाता है.
बिल्कुल. But Rajeev, the first part of solving a problem is to accept that there is one. So at least the panel here agrees that there has been a problem. And we all know that we've seen a slowdown in earnings. Now let's address how do we sort this? We have a problem. We have to accept it. FIs are selling because they're getting returns somewhere else. Confidence is low. Earnings growth has taken a bit of a hit. And to make matters worse, we keep putting more expensive stocks in the index. So that also takes away the index earnings, right? The 2% earnings taken away by the last inclusion of 2 stocks in the Nifty. So how do we address this problem of earnings, of markets?
I think it's a self-correcting problem in some manner. Some of the things are inherently cyclical, so input costs keep going up and down. So the corporate profit share of GDP sometimes is higher, sometimes is lower. I think what happened in the era of extremely loose liquidity is that competitive intensity across sectors went high dramatically. Let me give you a few examples, and this will probably incite some passions in the audience. Some people may have strong views here. Everyone wants to give 10-minute grocery delivery to you, right? There are 2 listed players. There's a third player, arguably pre-IPO.
Yeah.
There are some 5 other players in the wing setting up dark stores. Now everyone wants to subsidize you on grocery and go after market share. We got excited that big box retailers will do well. Then we gave them 100p multiples. We got excited about quick commerce. We said earning ki bhi zarurat nahi hai. We'll value in lakhs of crores. We said India is a growth market. FMCG companies should trade at 80, 90 times earnings. We said, okay, D2C ko bhi itna valuation de dete hain. All the old paint companies, big moats, we'll give them high valuations. The new entrant, challenger, usko bhi free pass mil raha hai. So somewhere, discipline in capital allocation, focus on cash flow, profitability, that will have to come. And that will only come when a few of the startup companies fail. If everyone and their uncle want to set up discount brokerage, there's only so much room for discount brokerage in the country, zero cost brokerage. So some weaker players will have to go out for the profitability to come back.
So do you expect that to happen in the startup industry this year? Do you see
startup or listed, ultimately when a business model is unsustainable and when they are unable to raise a new round of money, either from the public or from private investors, some players get shaken out. So the challenge again is, we had a panel in the morning. People are still talking about raising 5 lakh crores from public markets. Yeah. There's a new REIT which has filed for 7,000 crore money raising. So much money raising is in pipeline. There will be enough opportunities for investors. There's no hurry to purchase anything, and buy only when there's limited competition, there's genuine cash flow and profitability.
No, I was scared because I was moderating that panel, so obviously I heard that. So you're not still buying Zomato or Swiggy?
I can't name companies, but I'm not a fan of the consumption-oriented names. Despite the fall, like something which was at 100 times earnings, if it's fallen 20% in the cash, it's now 80 times earnings. Doesn't make it that exciting. And growth rates have started coming off for some of these big box retailers.
Oh, absolutely. Amit, do you think, we went through a period in which, I would say the second half of 2023 and first half of 2024, where, it was, as they call it, the BAP investing. Buy at any price. And, valuations were thrown out of the window. You just say that only momentum investing works in the market. That was the one thing that we were all hearing. Now, the momentum index and all the momentum stocks are down 40 to 50%. Now this year, if you're chasing alpha, what would your approach be?
Buy liquid fund. I'm joking. So, so what you just said, market started chasing high growth stocks, or this is part of every bull market. This is not the first bull market. Show me one bull market in last 30, 40 years where you didn't have the highest growth stocks bid up to the highest level ever. Be it Infosys, be it 2018, you'll have infrastructure names, you'll have some other names. It is not this bull market. It's how markets work. And we have to make money off it. We don't have to argue that why is the market working like this. We have to think how do we make money out of it. Our job is simple. Our number one goal is to make money of market alumni. This year is going to be a tougher year. It will take time. We've all made decent money. And if people didn't make money in 2023, 2024, it's okay. You'll have more bull markets coming ahead. But right now we are in a somewhat bear phase. Let's not be like super, let's protect capital. If we can protect capital and we can just, like this is how I think for my fund. If we can protect capital in like typical bear markets, if you go back in 1992 Harshad Mehta times till now, all bear markets, the downfalls are for 9 months to 12 months, typically. Now it doesn't mean that this downfall will also be from 9 months to 12 months. It can be 15 months, it can be 8 months, but broadly, it takes some time for the markets to correct. And then you find those new winners. There's a wave of consolidation, and that is how we want to play. First, we pray to God we don't fall more on the fund level. First is protect capital, protect your drawdown. If we survive this year without losing too much money, hopefully 2026 and 7, we'll have again those high growth stocks. Again we'll play those markets. Again these stocks will go back to 100p. I'm telling you. In 2027, now I'm telling you that there'll be again a bull. Like that can be in 26, I don't know. But again, that is how markets work.
Oh, absolutely. That's how the markets work, and that's how the psychology of money works, right? I mean, I'm just trying to talk about the next session as well here. But anyway, Lakshmi, in that case, what's the best asset class right now? Do you think equity is the best asset class given how much the market's fallen? Or is it now time to put your money in hybrid funds or put your money in some sovereign, some G6? I mean, how are you approaching the various asset classes now?
See, Anuj, this is the year of the snake, as per the Chinese calendar.
Of the snake?
This is the year of the snake.
Okay.
So the markets will play snakes and ladders with all of us. So when you reach number 98, if you played snakes and ladders?
Oh, absolutely.
Yeah. So if
I play it even now with my 2 daughters. So
that's right. So I play it on the mobile. So if you go to number 98 and you just think you're going to reach 100, there you come down. You come down right to number whatever, 15 or 18, and then you start up front. Okay. So I think in that kind of a market, there are going to be ups and downs, and the gully boys are going to become Jawans, and the Jawans are going to become 3 idiots, and then suddenly you have a deep seek moment, and then you said koi mil gaya, and that's what Nvidia will say. In that kind of a market, you cannot be wedded to one asset class. That's point number 1. Gold has been the absolute student of the year, 1, 2, 3.
Absolutely.
And maybe it's a sequel for the next year and this year as well. But can you just excessively get carried away and do just gold? Answer is no. So what is your end objective? That is going to be the critical driving factor, point number 1. So if your yardstick is that 100 ka 200 rupiya banana maybe in a span of maybe 5-7 years, then equity is still the answer. Irrespective of what numbers we are talking about, equity still has a very significant bearing on your portfolio. Gold will actually be the last person standing. It is going to be more like the Vishnu. Vishnu is a protector, okay, in mythology. So Vishnu of your portfolio is actually going to be gold. So I think it's a blend of all financial asset classes with the tail end of gold. And let's not forget the Cinderella, which is fixed income, which today is actually the shining star over and above gold in a lesser manner. But clearly that also plays a very integral role in your portfolio. So one can't give up one asset class to the other. Today the mood has become like this, that everybody wants to give up equities, or most of them want to do that, and probably get into safer alternatives, including alternate assets. And I find that a very misconceived notion, just because the recency bias in our mind is very, very strong.
Absolutely. Since you've raised this point, because I want to come to you now, because I now will talk purely about the equity market. The big complaint that the banks had was that we're losing money to stock markets. Nobody is depositing because everyone's moving their money to equities. In the last 3 months, we've seen some bit of reversal of that. People are now saying it's better to be in fixed income, right? So, in some sense, do you think that could be the sector that could lead the market next charge, banking and financial services, going forward?
No, I think so. Like I said, of course, some part of the money, because suddenly the fixed income as an asset class for a very large population has become attractive post-tax return, right? Because of the sheer tax benefit which was given in the budget. And if you are a family of 4, you can do investment in the name of so practically up to 50 lakhs rupees of income, you can, be tax-free. And that's a very, 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 very big deal. So I think, this will drive money deposits into the banking system, which is good, because ultimately you don't want, for any economy to do well, forget stock market, for the economy to do well, you need to have credit flow. Banks were struggling for the last 2-3 years on the deposit growth. So I do believe that this is a great sort of initiative, and it will have impact on the banking as a sector, but more importantly, I think it's healthy for the economy. So, if you ask me this year, last year banks didn't do well. So far it's been all right, but I think banking going forward could be big winner from a sectoral perspective.
Because what about you? Do you agree? What's the theme that you are backing right now at IDFC?
Yeah, so one theme, Anuj, that I've been a trend rather, not a theme, is that, and what Amit said, everybody is looking. We have to make money off the market, right? And family offices and HNIs, rather any investor is looking for that alpha creation, alpha generation idea, right? And what we've seen in the last couple of years is that we've seen very expensive IPOs landing in the market, very expensive IPOs, right? Which means if you start investing in a company right from day one, you're starting at a very expensive valuation, because IPOs have been very, very red hot, steamy valuations. So the trend that I notice is that a lot of interest is now moving to pre-IPO, moving to unlisted private equity space, because we feel that by the time the company is ready for a valuation, it is so expensive that I need to look at an opportunity to probably enter into that investment before that. And last year was great for IPOs, because at least the early part of the year was great for IPOs because markets were buoyant. Typically in years where markets are expected to be muted, where we are not expecting very, very expensive valuations, you will not see, and I heard one of the panel discussions in the morning where somebody said that we will have 60 to 70% lower number of IPOs as compared to last 2 years average, right? That will lead a lot of activity in the private equity space. And that increased activity in private equity space, I feel, is going to generate a lot of demand and interest of the investor community to look at, private equity space very, very actively, because they feel that the valuations, would be far, far attractive, before, let's say 2 years ahead of, if you expect an IPO to happen in 2027, this is a great year to probably catch some of those trends to kind of... so that one trend I feel is emerging very last 2 years, but I think 2025 is going to be all about that.
Oh, absolutely. Rajeev, do you think that would be a bit of a relief for the market, that last year a lot of money was sucked out by primary issuances, and we reached a stage where a lot of money is now saying, let me go into the unlisted space. There's no point chasing some of these IPOs. Now, it looks like the IPO pipeline is going to dry down a lot, and a lot of money could be available for secondary market. Market valuations have corrected a lot. So, do you think that we could be staring at a situation where everyone is so bearish, so nervous? This could perhaps be start of another big bull run?
Maybe. I don't know. I'm not, however, that sanguine about IPO pipeline drying up. So, one is that whenever listings happen, everything does not hit the market on day one. So there's a lot of stock which is locked up, or only a partial exit happens. A lot of these funds could come for maturity, the PE funds, etc., and where they may have to exit. Again, in some cases, the valuations are so egregious that even a 25% drop, people are willing to exit. Now, in the panel that you had on the IPO, someone made a point that we wanted a 2x valuation. Finally, we came to the market at X valuation, and then the stock went up again. But why were you wanting 2x valuation in the first place? So, I think 20% lower will the IPO pipeline dry up? I am not so sure. Investment bankers have to finally earn a living. I don't think they will give up that easily.
Okay, we got about 9 minutes left. We enter the last phase of this discussion. I'm going to ask each one of you what's your top bet is going to be for this year, for the remainder of this year. Vikas, I'm going to start with you. What's your top bet for this year, 2025? If you want to name a sector, you want to name a stock,
I think,
whatever.
In my opinion, banks will be the sector for the year. It will outperform. That's my call and bet also. We are overweight in banking and financial services.
Banking is a large universe.
Banks and NBFCs.
Okay.
And again, key thesis is again pivot by the RBI, growth accommodative stance. I think growth is coming back. So, yeah, and valuations are very, very attractive. Many banks are available at, in some PSU space, 0.6, 0.7 time book. So a lot of correction. I mean, yesteryears of, Kotak is available at 2 book, SDFC is at 2 book. So I think a lot of corrections have happened. Last year's sector underperformed. So I think this year, and many NBFCs are also, attractively priced. So we think that that's a sector which will beat this time.
But problem ये कि सब पूछ रहे हैं चलता क्यों नहीं HDFC बैंक? The argument सब ठीक है, but हर level पे selling is just not moving.
No, I was not recommending a stock. I was just saying generally. But HDFC Bank, I think, is going through an interesting transition phase because of the merger. The growth is compromised, and they have to raise deposit. They have to repair their balance sheet or prepare their balance sheet rather, post merger. And I guess probably you might see that another 12 months. So I was not actually commenting on HDFC Bank in per se, but in general, I'm not saying HDFC Bank will do well. Banking sector will do well. We don't own HDFC Bank. So
maybe I'll ask Samir कि चलता क्यों नहीं HDFC Bank at some point. हाँ?
आज तक highlight गिरता नहीं है.
Lakshmi, what would your top bet be for 2020?
I would want to agree with, I can say copy that. I think within BFSI, I would say banking definitely, it's been a laggard for a very long period of time. We like the consumer-facing NBFC segment, for example, those which are lending to the consumers in that's
They've done well.
They've done well,
yeah.
But we think that their space or their phase or their positive speed can continue. We like the insurance sector because interest rates will come down, but obviously there is incremental money which is getting locked at higher yields. So they will be definitely one beneficiary. Additional to that, of course, this is definitely the pole bearer of the sector, is the highest weightage. We also like the hospitality sector. Whether it's hotels, whether it's, travel and tourism. It's a niche sector, but there is independent or very individual stock taking place available in that segment. Again, they've had a very, very good run up. And we like this both in the listed because I toggle through listed as well as unlisted. There are very exciting opportunities available even in the unlisted segment there.
Oh, absolutely. The problem is most of them are not.
Kotak is our largest holding.
Good, at least my ESOPs will start running. It is so far been sleeping like worse than Kumbhkaran, I would say.
Okay, let's not talk about ESOPs, but anyway, let's move on. Amit, what would your top bet be for 2025?
See, actually, Anuj, my topics are changing so fast. I'll just give you an example. Rajeev spoke about quick commerce. Quick commerce was my largest weight about 3 quarters ago. And now I don't even know if it'll be there. Like right now, it's in the bottom. Because this blue ocean high growth industry just moved into a red ocean in no time. It's happening in exchanges. It's happening in cola wars. The speed at which blue oceans are turning into red oceans, from your paints to in all consumer type this thing, is mind blowing. And this kind of competition intensity we've not seen before. So what I'm seeing is, let the markets tell me. This is a little contradictory, but the leaders of the next bull market will hit new highs at some point of time. Let the markets tell me where the markets are showing new signs of high earnings growth.
The stocks that first hit the new all-time
No,
high.
but they need to be value. Like initial neglect plus value should be there.
Okay.
It will not come with high P multiple. This is what historically has happened.
Okay.
We are only, see, I was a student in college where I used to see the last 10 question papers, study the last 10 question papers and attend the exam. I do exactly the same thing now in fund management. Historically, initial large leaders are value, but making new high, and it has some component like PSUs. It had massive neglect, they were value, and nobody in his right mind, including me, unfortunately, because my mind was wrong, but I thought it was right that point of time, would touch it. It will always start that way. But hopefully, I don't know if we'll get it right or wrong, but we'll try.
Okay. Vikas, you want to come in?
Yeah, I would have said BFSI, but since Vikas and Lakshmi, both of them mentioned that, my next best pick would be infrastructure. I think one thing that one cannot really question about this government is their intent and push on infra, right? I mean, that can trigger a debate where people who are harrowed by the dug-up Mumbai roads, but the bigger, the larger picture is that an example of how the Mahakumbh was, orchestrated recently. And I mean, imagine maybe 20 years back, could a small, medium-sized Indian town could have accommodated, so many million people coming over and, managing it practically seamlessly. I'm sure there is a lot of thinking that the government would have put behind that event, and similarly they're putting a lot of thinking behind. I mean, if you travel anywhere in the country, you see a lot of development, a lot of infra-related activities happening. India seems like a country that is work in progress. So I think any theme that's related to infra, all across the entire infra ecosystem, I think is the next 1 decade theme, according to me. After obviously BFSI.
Oh, absolutely. I think we've seen some of that in Mumbai with the coastal road and metro. Just don't talk about this whole digging up the roads.
Fabulous. I mean, ask people who live and work in BKC.
Yeah.
Going to town has become absolutely.
But how do you exit the BKC? That is the tough part, right?
You walk, you crawl, and then you drive.
No, because I tell you, I did my show. I came here and then I told my driver, look, there's a good chance that I'll have to walk to the Geo, because once you enter BKC, after that it's a bit of a nightmare. So anyway, that's for some other day. Maybe that's a different angst. Rajeev, what would your top bet be for 2025?
It's the same, private sector banks. I can give you more reasons if you like.
Absolutely.
Yeah. So one of the things that has happened is, if you look at the yield curve, and Lakshmi will know this very well, it's been very, very flat. So 1 year, 10 year, more or less same thing. So today a bank is raising 1 year money at 7.5%, and at that rate there's hardly any spread for their home loans or for their other high quality lending. Given the relatively high short-term rates, the CASA also has been under pressure. So today people are very particular about making FDs and then doing those smart money swaps and things like that. And RBI is serious about adding liquidity. I think short-term rates will come down eventually, given the seriousness of RBI. And valuations are good. Asset quality is good. They haven't done much for a long period of time. I think it's a consensus buy in that sense.
Oh, absolutely. It's a consensus. Rajeev, Vikas, Amit, Lakshmi and Vikas, thank you so much for your time today. And that's all that I have from this fabulous panel. Thanks a lot. You've been a great audience. Thank you so much.
Thank you.